Hello, everyone, and welcome for this new episode of ThinkMacro, where today I'd like to focus on a market phenomenon that will undoubtedly soon have macro implications. I want to talk about the rise of long-term interest rates. Over the last 2-3 years, central banks have cut rates, and yet long-term rates have gone up. So that unusual phenomenon has serious implications. And you see that in Europe, in Japan, in the US, all together. And this phenomenon, of course, has direct implications through the cost of debt, but also indirect implications. And we're going to focus on these. But first, what are we talking about? What makes investors ask for more to lend to states? Well, first, creditworthiness. Of course, as an investor, if you perceive a risk of non-repayment, you want to be paid more. Okay. Then there's inflation. If you think inflation is going to rise, or control is going to be lost on inflation. And of course, that means that the value of the money you lent to the states is going to get eroded, and you're going to be what you're going to be repaid with will be worth less. So, second reason for an investor to ask for more payment, a higher interest rate. And third, more recent, really, and somewhat surprising in developed market, the institutional framework. As an investor, you want to be sure that the legal framework, where the rules under which you lend money are not going to change. You don't want to have a big, populist government that in the course of your loan decides not to repay for electoral reasons or something like that. So you want stability on the institutional side. You want to know the rules, and you want those rules to be stable. So these three risks, all taken together, may mean investors want to be paid more. For 30 years, there was no issue. But over the last 3 years, these three risks have come back to haunt us. First, creditworthiness. After the COVID crisis, we had to borrow more. Many states had to borrow more money to restart the economy, to make sure companies would survive. That means today a debt to GDP that comes a lot higher than before, and hence the question of the creditworthiness. If you take the numbers of the CBO in the US, and they don't have particularly pessimistic assumptions. They're saying today the debt is at 120% debt on GDP. If nothing is done on the fiscal side, if there's no major adjustment, it's going to reach 150% in 10 years and 200% in 20 years. So you can see that it can really slip out of control rapidly, debt, if nothing is done. Second, inflation. When states had to restart the economy, they had to inject a lot of liquidity in the system, and that in a synchronized manner. So all states had to do the same at the same moment, and that did reflate the world economy up to a point. We had serious inflation back 3 years ago, and we can see today it's not easy to take it back under control. And that inflation comes as a second risk to investors, and that's a second reason for them to ask for higher rates when they lend to states. And last, more recently, we can observe that the institutional framework we thought that was just stable, particularly in developed markets, comes now in question. We've seen 3 years ago the US government spending more, adding to the deficit at a moment of good growth. You can see here and there governments putting pressure on the central bank to cut rates, and meaning their independence might not be guaranteed anymore. We've seen, again in the US, a central bank just changing slightly its mandate and saying, okay, I'm going to focus more now on growth at the expense of inflation. So we have that notion of institutional framework that might not be that stable anymore. Rules come under pressure. They may change for investors. And that again means a higher rate you ask for as an investor when you lend to these states. Now, what are the implications of higher long-term rates? First, there's direct implications. Of course, that means states, households, corporates borrow at a higher price. And that comes as a brake on the economy. Now, it may look small, but it's not. When you look at what happened in the US over the last 5 years, rates went up, the long-term rate, from 3 to 6%. They doubled, essentially. That's a 30% increase in price when someone wants to buy a flat or a house with a 30-year loan. So that is very significant. That's big, even for wealthy households. Now, there are also some indirect implications, and they're a bit more subtle, but in that sense, they're vicious. Higher long-term rates reduces the efficacy of both monetary and fiscal policy. On the monetary side, if when you cut rates and you hope for some stimulation of the economy in cutting the cost of capital, but if as a reaction, investors conclude that means more inflation in the system, long rates may well rise. And actually, they did rise over the last 12 months, even if central banks were cutting rates. And that, of course, means what you give with one hand is taken back by the market through the steepening of the curve from the other hand. So what you would expect as a stimulus, of course, would come diluted a lot, if not suppressed by the rise of long-term rates. Now, same with fiscal policy. If when you come with a fiscal package, solvency becomes an issue, then markets may say, my creditworthiness has deteriorated. I want higher rates. And what you give to the economy with a fiscal package, from one hand, the market takes back, from the other hand, in raising long-term rates. That's again what happened this year, particularly in the US, as a reaction to what the market considers as too much of fiscal deficits for the economy. So what used to be very strong and efficient tools to restart the economy in front of a shock, to support the cycle when it needed to, monetary tools, fiscal tools now come as a lot less efficient because of the market reaction on long-term rates. Now, this new situation where the market reacts immediately to any decision on the monetary or the fiscal side on the long end of the curve completely changes the ability of authorities to react and to absorb shocks. And if you just, again, take the example of the US, we've had for 30 years a central bank, a government that on every shock would react strongly and efficiently to restart the economy after the dot-com bubble, after the GFC, after the COVID crisis. Now, today, if these tools prove a lot less efficient, of course, that means we've lost essentially the Fed put we've had for 30 years. And that's a serious change because that means that the risk we're bearing as investors to hold these assets has increased. And now that takes me to the second indirect effect of the rise of long-term rates on the economy. When you are in this system where you artificially take short-term rates down more than they should, beyond where they should be to balance growth and inflation, and you've got this focus on growth, they are lower than where they should be. You basically cut the cost of capital, and in that sense, you fuel investment in risky assets. And you may fuel too much speculation and too much inflation in price of these assets. And of course, there, I'm thinking of equities essentially, precisely at a moment when they're getting more dangerous because, on the other hand, you've lost the efficacy of your safety nets. So in that sense, the mechanism today in the US economy consists in attracting the market through cheap capital closer to a cliff. Authorities are digging for it. So that's a difficult, a dodgy situation for US investors we're getting in now. So in short, the rise of long-term rates has direct implications on the cost of debt, but also indirect implications through in reducing the efficacy of monetary and fiscal tools, and in favoring some further leverage on assets at a moment when the opposite actually should happen. So this is sort of a poison that you need to control, and central banks, and particularly the Fed in the US, must today keep control of long-term rates. Now, how are they going to do that? The answer, the textbook answer is simple. You just cut costs, raise taxes. In that way, you improve your ability to repay. In that way, you slow down the economy, and that takes inflation down. You show that your countries manage in a rigorous manner. Your credibility rises. Investors are happy. They accept a lower cost of debt and to lend you at a lower price. Perfect world. That works. Now, it's unpopular, of course, and particularly in those countries at stake today, that, France, the UK, the US, that are where they are today precisely because these measures were too difficult, or they could not afford taking these measures. So they need to find an alternative solution. In the US, it's already being implemented now. And so what could that be? By construction, it's a lot more hazardous and dangerous, but that's where the US is heading now, in accepting higher inflation and together with it a weaker currency. The US administration hopes to improve the creditworthiness, the stability of its debt at the expense of foreign investors. They essentially lose twice. They lose because long-term rates are higher, inflation is higher than it should be. You accept a form of higher level, less control on it, more creditworthiness issues. So the value of their debt drops, and together with it, you debase the currency, and they lose a second time through the channel of the dollar. Now, the US can afford to rob foreign investors. It would not be their first time. They are in a strong position, but it's still a dangerous and a hazardous game. First, inflation is a lot harder to control when at 4% rather than 2%. 2% is not a magical number. It's been chosen by most central banks precisely because inflation is a lot easier to control when at or below 2%. when at 4%. And inflation is a slippery animal. When at 4%, the risk is that inflation expectations get de-anchored, and economic agents, start pricing it in their behavior, and you sort of spiral, and the risk is then that it accelerates. And we all remember how long it took in the 80s to get back inflation under control. 10 years of forceful policy just to take it back under control. So that's a dangerous take here on inflation from the US administration. Now, the second challenge and difficulty they are facing and going to face very, very soon, you need new investors. If foreign investors are getting spoiled with their investment, they may leave, and they are already actually getting away from the US debt. So you need a new investor to replace them, and you need more of these because your debt is ballooning up. So that's a big challenge. Now, there again, measures are being taken when the Treasury decides to issue short-term debt rather than long-term debt. It alleviates the pressure on the long end of the curve. Now, you can do that up to a point. Now, the US debt is already one of the shortest in the world, 6 years average maturity. So you can issue more short-term, but of course, in doing so, you have to renew it more often. So that can work for some time, but not forever. Also, the Fed recently said, okay, I'm going to halt my QT program. I've bought a lot of debt after two big crises, sold some of it. I stopped that. Now, okay, that also alleviates the pressure, but at the expense of a still big balance sheet at the Fed, which of course makes it fairly fragile for the future. Now, because all that will not suffice, it will not be enough, you have to push that further, and probably the next best good answer would be to incentivize, maybe force in some way, banks, financial institutions to buy more of this debt, which is something you can do. I mean, Europeans did that back 15 years ago. You just cut the cost of capital to when investing in the state debt. That's been discussed now for some time in the US, documented. I think all is ready. It now takes just to press the button and get there. First, in controlling the yield curve and reducing the efficacy of both monetary and fiscal policy, authorities are increasing the risk investors have to bear. Second, in devaluing the value of the currency and in artificially taking rates lower than where they should be, authorities are spoiling foreign investors. And in that sense, they're pushing them away from lending. So the immediate conclusion is for them to just get away of US debt, and in doing so, adding to the pressure to US assets. So what was seen a year ago as a risk, a credibility, an instability risk by the new administration now is being organized in their action. They are now devaluing the US assets. You can expect the dollar rates, and as soon as the AI frenzy is over, probably equities as well, to come under pressure next year again. So that's it for this episode of Think Macro. Thank you for tuning in. I hope you enjoyed, and see you soon for the next one.